Corporate Finance Presentation. Net Present Value, NPV. Get ready, it's time to take your chance with Corporate Finance. Net Present Value, NPV. When thinking about capital budgeting decisions, those types of decisions that will have cash flows out into the future, generally over a year into the future, the primary tool that should come to mind is the net present value, the NPV. One of the great characteristics about it is that it does take into consideration the time value of money. It's going to take the sum of future outflows and inflows. So remember, where you're going to apply the tool of the net present value is typically a situation characteristically when you're going to put down some initial lump sum of money that you hope will generate inflows into the future, years into the future. That could take the form of putting money into equipment, putting money into a project, putting the money into inventory, which you hope that will receive a return in the future. Because you're looking multiple years into the future, there's a lot of uncertainty. One of the tools you want to take into consideration is the time value of money. So the general idea then is that we can break the future inflows and outflows, and note that we will take a look at this basically on a cash basis, looking at the cash inflows and outflows in the future, trying to group them into years so that we can then apply our present value calculations to them. So often discounts using the company's weighted average cost of capital, WACC or WACC. So when we do our present value type of calculations, we need to use some kind of discount rate. The discount rate will often be the weighted average cost of capital. Now note, when we're thinking about the time value of money, you might be saying, well, the rate that we should use should be, say, the inflation rate, 3% or so, whatever the inflation is at that point in time, so that we can take into consideration the decrease in the purchasing power of the dollar. But that's not how the calculation is going to work here. We're going to have a discount rate that basically includes in it what we expect our gain to be, the profit included basically in the discount rate. And that's usually going to be, or often will be, the weighted average cost of capital, which we discussed in prior presentations, how to basically get to that weighted average cost of capital. Obviously, the discount rate is going to have a significant impact on the calculation of the net present value. So we need to put some time into the consideration of what would be the proper discount rate to be using when we apply our time value of money, when we apply the net present value calculation. So it's also the net present value calculation, the NPV, a very common and widely used method. One of the things that makes corporate finance and decision making into the future difficult is that there's not one way to do certain things. You have best practices to do certain things, and the net present value is one of those best practices, but there's not a set rule set in stone on how to make any particular decision. That's different than if we're looking at, say, financial accounting, looking at past information and then trying to align it in such a way that it's in accordance with some set of rules so that it can then be standardized. When we're taking this information and then projecting out into the future, there's no guideline to say this is how you must do this thing, but there are certain things that are considered to be the best practices, and the net present value calculation is one of those things that basically there's agreement on if you talk to other people about, your decision-making process and how you went through the decision-making process, and let them know that you use the net present value and you have a fairly systematic step process in how to go through that decision-making process. That doesn't mean the fact that it is somewhat standardized, that you have to do that or have to have that in some particular way, but it's very useful to have that standardization so that you can communicate with other people about the steps you took in order to make a particular decision. So a project will look something like this, and the best way to get an idea of this net present value types of calculation is to do practice problems. We will have a lot of practice problems both in Excel and outside of Excel, and just working the practice problems is the way to go. But a typical type of scenario is that we're going to have money going down for an investment in some way, shape, or form. It might be a project, it might be inventory, it might be equipment that we're purchasing. And then we're going to have the cost of capital. That cost of capital is the rate at which we're going to discount the cash flows. Remember that discount rate is going to include what we expect our return to be. So it's not just basically the interest rate. It includes what our expected return will be. The confusing thing then about the net present value, the NPV, is that when we get to the bottom line here, if it's zero, then we might accept the project because it then cleared what you can call like the hurdle rate over here, or the cost of capital, the weighted average cost of capital. This rate could be called different things, by the way. The discount rate, weighted average cost of capital could be called the hurdle rate and whatnot, the discount rate. So just be aware of that. And if you're using that rate and then you calculate the net present value and it comes out to 0, that means that you have met that rate. If it's greater than 0, that means that you have cleared the rate and you might then accept the project. That's a little bit deceiving, because when you think about the net present value and you use your present value calculations discounting things back to the current period, discounting future cash flows back to the current period, you might then think that this bottom line number represents basically your income from a dollar standpoint after taking into consideration, say, things like inflation. But that's not the case. It's not just the time value of money you're taking into consideration, because the rate you're using includes the gain that you're talking about. So anything above 0 then is something that cleared that. So if we had the future cash flows, for example, from X1 to X6 that are the 47,000, the 62,000, the 56,000, negative 48,000, 160,000, and then 40,000, we list these out from period 0 to period 6. These are years that we are considering. Here's the cash flow: outflows negative, inflows positive. We get to a positive 117,000, 117,000. That would be like our net profit, net gain after the 6-year time period, not taking into consideration time value of money. Now, if we went through each of these line items and basically present valued them one at a time, we can't use an annuity because they're uneven in nature, and use the discount rate of the 14%, the cost of capital, then we can go through each of these and imagine that we're going to discount these back to the present time period. And if we sum this up and get to a negative number, that means we haven't cleared the 14%. Again, even if this was a positive number, that it's a little deceiving to see these things side by side, because when you see this one, you're going to say, oh, that doesn't take into consideration time value of money. This one does. And again, that leads people to think that you're only talking about basically inflation that's going to be involved there, and you're going to try to compare these two numbers. That's not the case, because even if this one was 0 over here, we had cleared the 14%, which includes what we want in our gain. So again, we'll do many calculations on this, many practice problems. Best way to understand this is to work multiple practice problems. Also note that when you're comparing to other projects, the net present value is one of the major calculations, but the other one is the internal rate of return. In other words, if this one clears 0, then you cleared the 14%, which could be called the hurdle rate. But if it's greater than 0, then you don't know exactly what the rate of return was on a percentage basis. You know how much the dollar amount is over, basically the hurdle rate. The bigger this number, the better, because that means, of course, you cleared the 14% by more. However, you don't know the percentage basis, and the percentage basis would be the internal rate of return. So the internal rate of return is the other calculation that will commonly be used, and it does take into account the time value of money, and it complements and is related to the net present value. We'll talk about that next time. The internal rate of return is the rate at which the net present value calculation, if used, would result in 0.